Good morning, ladies and gentlemen, to a very special show, Market Guru, where you get to meet the finest fund managers, equity strategists, and individuals who've navigated Dalal Street in a manner which creates a lot of wealth in the medium to long term. We are very, very fortunate to welcome Mr. Dinshaw Irani. He's the CEO of Helios Capital, the man behind the successful launch of Helios Flexi Cap Fund, and as I have often said, India's happiest investor. Namaste to you, Dinshaw ji, and a very warm welcome as usual. It's such a pleasure to speak to a person who always smiles no matter what the situation is on Dalal Street. Characterize for us the sentiment on Dalal Street. We are at 9 months high on the Nifty, at the cusp of first quarter earnings, and against the backdrop of a very severe action that SEBI has taken against one particular aggressive quant trader.
Shail, first of all, thank you for having me on your show, and a very good morning to you, your team and viewers. And it's always a pleasure to be on your show. And about the smiling bit, life is a lot of pain. It has a lot of pain, and so has the stock markets. The best way to avoid that pain is keep smiling. Creates dopamine in the body, by the way, scientifically proven. But anyway, so that's it. We don't expect much of positive news coming from the quarterly numbers per se, given that the first 2 months of the last quarter, when the management commentaries were available, they weren't that exciting. So I don't think this quarter will be a trigger for the market to move up. Having said that, Shail, our belief is that the market is just poised for some positive news. And frankly, I mean, that all stems from the fact that RBI, the way it has gone about infusing liquidity in the system, I think it's like fuel lying on the floor, and you just need a spark to light it up. And that spark, unfortunately, as I said, doesn't look like the quarterly numbers. Even the trade deal, the sound bites that we've been hearing from the press and whatever little that we can pick up, it's looking like it's going to be a compromise kind of a deal. It's going to be an interim kind of a deal, and not a final one. So obviously that also is not going to provide that trigger that the market is looking for. Our belief is that the trigger, as and when it comes, will be probably the September quarter numbers, because by then things would have picked up and we'll start declaring numbers into the festive season. So that should be a very good time period for the markets to pick up and move from there on. So,
okay, I think most of the seasoned watchers in the market would not be a worried lot. From a low of about 21,700, the Nifty is appreciated 17% so far. It's a very nice 4,000 point rally. And, maybe a month or two of sideways trend will also let option sellers enjoy maybe 1 or 2 months of peace. But your thoughts on how SEBI has reacted to Jane Street's visible manipulation over the last 2 years or so in main indices, Nifty and Bank Nifty. How do you see this regulatory action that has come up on this quant trader? Which side of the equation are you on?
No, I think it was justified. I mean, if normally when you do these kind of trades, you take the big leap that it's a hedging kind of operation that they're undertaking, but it wasn't hedging. It was actually not hedging. You're selling, you're buying X amount of cash, and you're selling out some 7x, 8x amount of options. So obviously it's not hedging. They're trying to make money on both sides of the trade. Even when they're selling, they were buying options at those levels as such, at those quantities. So obviously, I think SEBI's done a wonderful job and coming down heavily on this. And I feel that this is required, because retail investor, you saw a lot of interest on that retail part also in the F&O space. And once he burns his fingers, in fact, the glaring data was 91% of the investors are losing money on every single trade, it seems. So that's really a sad case. So with money power, you can turn market.
150 crores as an AUM, and in the last November 2023 this was launched, so almost 18, 19 months, 20 months have passed, and you've posted a very stellar return of about 27% CAGR. Let's analyze the structure of the fund. Extremely overweight in the financial space. You have two major banks as your first and second top holdings in the fund, which is HDFC and ICICI. How do you see the environment in the BFSI lending space at this point of time? There is some apprehension in the market that earnings at banks will be a bit constrained, given that RBI has cut rates. Banks will have to automatically bring down cost of the products that they sell, but their cost of funds will remain same for maybe 6 months or so, till the time new fixed deposits are renewed.
So, Shailendra, let me take you back in history and probably explain why this overweight in BFSI before we talk about banks per se as such. So basically, I mean, normally we have a saying that what you learn from history is you don't learn from history. But we try to learn from history, and that's why we look at the markets, the big markets that have done what India is expected to do in the next 5 to 10 years, right? We're going to be the third largest economy. There's no doubt about that. We're going to be the fastest growing economy. Again, no doubt about that. So let's look at the big economies which did that, like the US or say China or even Germany and Japan to an extent. So whenever this growth rates kicked in, it was the clear winner was the BFSI sector. Mainly the growth rate kicked in because, I mean, the growth rates picked up because of consumption kicking in the GDP space, right? So it was more of consumption driving the GDP as such than the investment part. When that happens, the BFSI space has a double whammy because they not only fuel the consumption by way of giving out loans, credit cards, unsecured debts and stuff like that, but they also fuel the back end of the economy, the consumption, which is the manufacturing company needing working capital and stuff like that. So inventory and so on and so forth, right? So it's a double whammy for these guys, and that's why we are, and we remain overweight on BFSI. In fact, massively overweight on BFSI. I think our weight is in excess of 45%, if I'm not mistaken, in most of the funds that have diversified holdings per se. And obviously, the lenders. Being what they are heavyweights within the sector itself. Having said that, even the lender space, we don't have much of public sector lenders, banks rather. And that's mainly because they are into project financing and stuff like that. They're not the consumer facing banks. Most of them are more of project financing. So that's why the only public sector bank that we have is SBI, which is, I think, a fairly heavyweight on consumer financing. And private sector private sector banks we like because of the way they are in consumer financing. They're very, very nimble footed as such. Yeah. So that's the reason why we are more heavy on private sector than on public sector. And secondly, having you said about what RBI's actions will have an impact on the lending space. Now, having seeing that the RBI used, I won't say a bazooka, but a bunker buster by way of giving a 50 bip cut in interest rates and a 1% cut in CRR, I think that will have a bit of an impact on the banks. The earlier cuts were fairly nimble. I mean, they were absorbed on the way along, but the NIMs will definitely have a problem. In the private sector, we expect the NIMs to have, probably this quarter will be the biggest reset for NIMs. Going into the next quarter, and they'll be nimble-footed. They will cut their deposit rates and stuff like that. But the next quarter, I think they'll be more or less insulated to that extent. But do not forget, with this kind of a CRR card, the liquidity also which comes into the system helps them to absorb this to a greater extent. And that was also needed. So I think banks will come out of it fairly quickly. The NBFCs, however, are clear winners. They are the ones which are, I mean, on a short cycle on both legs of the balance sheet, be the lending or the borrowing. And anyway, they were having problems of borrowing because of the tight liquidity in the system. And with this liquidity infusion, I think they're a better place. So you'll see that our mix also has changed quite appreciably towards NBFCs than towards the banks.
Absolutely. This was my second question, and let me just share some details of the overall structure of Helios AMC. They have added positions in Bajaj Finance, have almost doubled positions in Aditya Birla Capital. They've added, companies like India Shelter Finance Corporation, and of course, the big daddy of them all. I think the finest balance sheet that I have read over the last 30 years, Sundaram Finance. Dinshaw ji, how this extreme likeness or enthusiasm for the NBFC space, what tickles you? Is a lot of EPS growth coming in, or is the lower cost of funds the main attraction?
So basically, Shirendra, the fact is that banks can only access that much. In fact, banks also, they use the NBFCs as a conduit for getting into inner markets. I think India's growth is going to be phenomenal going forward, and obviously it's going to be driven by the deeper down kind of consumption which is going to come in. And I think that's where these NBFCs come in as really helping out the system as such. And that's why our belief is that NBFCs will show a far faster growth in earnings, even though their valuations are fairly stretched, I would say. But given that the next 3 years, the earnings are going to be in multiples, I think that's where our comfort comes from. And I think that earnings, I mean, the valuations will even out as we progress into in the future.
Okay. One interesting thought that we've discussed earlier as well is your extreme dislike for technology. Old world technology as we know it, the likes of TCS, Infosys, HCL Tech, none of them find any presence in the overall AMC's portfolio. But you're very, very bullish on the internet companies. There is, PB Fintech, Policy Bazaar, there is Paytm, there is Delivery, there is Swiggy, and of course Zomato in the portfolio. Some of them have also shown increase in positions. You see the new world better off than legacy technology?
Definitely, Chandra. I think that's where India has a edge as compared to other markets. The kind of new platform companies that we come up with, I think that's a clear winner. In fact, any investor who comes from outside looks at these companies as a very interesting bet to go forward with. But having said that, even the growth rates here are going to be much more exciting. I'm talking about the new age company. I'm not talking about the platform companies as we call them. That is where the real growth is going to come from. And that's why we like those as such. Having said that, in the IT services space, which is where the old companies are like TCS and Infosys, we don't like them as of now. I mean, I think the best growth phase for these guys are over. This year, the largest client, which is US, the market of US rather, I think that is going through a very uncertain phase. And frankly, I mean, when such a phase happens, the companies within US will have two minds whether to go ahead with the discretionary spends or no. They'll probably hold back on that. They'll probably do spends which keep the light on rather than some fancy stuff. So obviously the discretionary will take a back seat. And when that happens, your margins collapse. And having seen the balance sheets, most of these big, large IT companies have come out there, the balance sheets, the employee pyramid out there is getting deteriorated. Earlier, the pyramid used to be the lower earning base, used to be the largest base for them. Now that base is shrinking. So if that's going to happen, you're talking about lateral hires, because obviously the skill sets are now needed more and more out here, having AI coming into the picture. That's why it's now becoming into an oval kind of a shape, which is not healthy for IT companies. The manpower cost is the largest cost for these guys, 55% for most of them. So obviously that's going to have an impact on the margins per se. And having again reiterating again that AI, I think, is a big disruptor in the IT space, because for the last 30 years, our IT model has been surviving on number of people, into number of hours, into rate per hour. Uh, but that I think has taken a backseat because number of people, because of AI, will shrink. Number of hours spent by people, by a person will shrink, and obviously rate per hour, I don't think we'll be able to adjust even the best of case. So that way.
Okay. Dinshaw, one entry that has happened in the overall AMC is Niva Bupa Healthcare. This is, of course, a recently listed company, less than a year old. We saw the listing in November of 2024. What makes you so bullish on Niva Bupa at a time when possibly, we haven't seen much of value creation in long-term insurers apart from maybe ICICI Lombard or maybe SBI Life. What do you like in Niva Bupa Healthcare apart from the price ticket of 88 rupees?
So I won't comment on the individual stock, Shirendra, but I'll tell you this much that healthcare has been a total laggard in our system altogether. I mean, as in I'm talking about health insurance, quality healthcare in terms of hospital rooms also and stuff like that. Because I think the per capita incomes, which were fairly compressed at this point in time, and if you remember, my whole caveat was that India is going to be the fastest growing economy. It's going to be the third largest very shortly. Obviously, the thing is when you grow so fast, your population is not going to keep pace with this kind of a growth in your GDP. So obviously, your per capitas are going to expand much faster, right? And when that happens, your share of wallet, which goes into your essentials, will obviously shrink. The discretionary part will keep going up, and obviously healthcare, rather insurance, which has taken a backseat thus far, I totally underpenetrated, and that's why we are looking for ideas within the healthcare insurance space, health insurance space, and that's why we chose a Niva Bupa, not only because of the ticket size, but obviously because it was one of the reasons we priced one, and obviously that's not the only one we have in health insurance because others also lined up out there.
Okay. The other thing that I notice is that you have eschewed from following the healthcare trend, next to no hospital stocks at all. So possibly Niva Bupa is an ancillary play in the healthcare sector. Maybe, just maybe.
Yeah, it is. Actually, we have a few hospitals also, but unfortunately, they're very expensive, all of them. So that's why we have only a handful of them as such, and rather two big ones that we have in the portfolio. And we're looking for ideas there also. But I think, again, in the healthcare space, in the hospital space, quality rooms, the paucity which is there has driven, because of this paucity, whenever there's a spender, I mean, the ARPOBs, the revenue per occupied bed, were shot up to 65,000 in some of the hospitals. And that makes it very interesting because with those kind of ARPOBs, the break-evens for a new hospital comes down sharply. Earlier, the break-evens used to be 18 to 24 months, and now they've literally come down to, I think, around 12, 14 months or so. So that helps them set up newer capacities, and obviously you see a flow of hospitals also happening here. So it's going to be interesting times even in that space.
Okay. And the third largest holding at Helios AMC is an unusual stock, which is Adani Ports. Any thoughts on the long-term growth characteristics of India's largest port company?
So it's not only the largest ports company, it's the largest logistics company in India. And when you're talking about India growing so fast, obviously logistics is going to be a big contributor to this kind of growth. I mean, it's not just to make you understand how big we're talking about is a fourth of the port capacity lies with Adani, 40% or more of container traffic lies with Adani as such. So it's not a small company per se, and that's what has driven us. And by the way, it's a company which has got enough cash flows. It's got free cash flow positives. enough to service his debt. I can justify it on P's, on EV/EBITDAs, on any DCFs or whatever you will. And that's what we liked about this company, and that's why we, being the largest logistics company, we couldn't have avoided this.
And the fact that Adani Ports over the last 3-4 years has been in a sideways zone, not created much value for long-term shareholders, probably, maybe your luck will rub out on the company as well.
Yeah, hopefully, but that's not the constraint. The fact is that if the growth keeps happening, that's good enough for us. And by the way, you know what happened with the group per se. There was this attack by one of the short sellers, and I think that's what has given this.
And the points that you mentioned in the defense of Adani Ports, that you could defend it on genuine cash flows, great business opportunity, plus obviously the sheer logistical presence on peninsular India is one of the reasons, among the many reasons why Adani Ports survived that carnage and continues to do well.
True, very true.
Okay. The one thing that needs also to be defended is Hindustan Petroleum. This has been with the Helios Flexi Cap Fund from the first month that you started your business in, somewhere in Jan of 2024. Again, not much of value creation that has happened. Is this, something that you will believe will ultimately give value, or I'm sure it's not a dividend play?
No, it's not. It's not. Shirin, so the fact is, it's got a lot of moving parts. Okay, the only overhang that stock used to have earlier was when the crude prices went up. The government never allowed him to increase prices. Rather, not him alone, but other the marketing companies, oil marketing companies, to increase prices. And when they fell, they were asked to cut their prices as such to come down to some realistic levels and all. If you notice, that hasn't happened this time around. I mean, when the prices went up, obviously they weren't allowed to increase prices. But when they came down, and they've been down for a while now, the crude prices, the companies were allowed to make abnormal profits. Because I think that's how the government has realized that they need to survive, right? All these OMCs need to survive, they need to service the public also. And as a result, they said, instead of us paying the money, the public gets used to, the consumer gets used to a certain level of crude prices, rather the retail prices. So let them bear those prices, even when the prices fall off for the crude, this thing. So the company ends up making abnormal profits per se, and as a result, even when the prices move up, the losses don't hit them as much, right? So they end up making money. That's one reason why we realize that, look, the valuations are pretty cheap. If this is how the government is going to behave, I mean, this is good enough for us. Secondly, look at the moving parts within. I mean, they've got enough value creation not subsidiaries, rather divisions which can unlock value for them. I'm sure lubricants will be one of them, which you'll be hearing about shortly. So when that happens, you'll realize that there's a lot of value lying in this, and that's the reason why we prefer HPCL over other OMCs.
A couple of final questions, Mr. Irani. When you look at the overall representation of defense in Helios AMC, there is one stock, BEL, again from the first portfolio onwards. So it's been a great value creator in Helios AMC, but a complete absence of other multi-baggers, if I may say so. What do you like in BEL per se, and what keeps you away from maybe shipbuilders, maybe aircraft makers, even private defense players?
So actually, Shivanji, so let me start off with BL only. Now BL is an electronics fellow, right? I mean, he's not into manufacturing hardware and not hardware, rather hard assets like an aircraft or a ship and stuff like that. The problem with these kind of manufacturing processes is it's one, very time consuming, and two, you need a lot of capex if you want to expand capacity, right? So that's why we realized that, look, these guys can only, and by the way, HAL is totally dependent on US for supply of engines per se. So that was another setback for us. We weren't too comfortable with that process also. And secondly, both these, or rather any of these hard asset companies were quoting at very exorbitant premiums. So that's why we avoided those guys, right? Coming to BL, as I said, it's an electronics play. Capex is not a big issue. I mean, it's just a line being set up. They don't have to worry about massive capexes. And thirdly, the beauty about BL is that it's a agnostic play. It can supply to the army, to the navy, to the air force, whichever wing of the armed forces needed. It can supply that, and plus it has enough diversification into consumers also. I mean, it can go into drones and probably electronics and stuff like that. So, and the final mover was the fact that India will one day become an outsourcing base for defense, and because we are a friendly country, we've never shown aggression, and obviously people like to deal with us. So it's obvious that the best choice would be electronics first, and then probably the hardware that comes along with the electronics will come later as such. So that's the reason.
Maybe the entire defense space is at the cusp of what Indian IT was before, what was it, Y2K?
Yes, Y2K. But no, not really. Shailendraji, so our belief is that in the hardware space, you need to up your game. I mean, HAL per se, if you've heard the Air Marshal, he's been the chief of Air Command. He's been not too happy with them as such. So it's obvious you need to up your game there, and that's when you can do that. But I have no doubt that the shipbuilding space will be a big winner going forward. But as I said, the valuations are very stretched out there, so I don't think we'll be touching that.
Okay. And how about valuations in the EMS space? This is again a sunrise area for the entire Indian economy. The PLI scheme is doing very well. We've had huge wealth creators in the form of Dixon, so many of them, PG Electroplast, Amber. But our valuations are concerned for Helios as far as EMS space is concerned. Again, not much of a presence, at least in the first 30-35 stocks that I checked.
Yes, we have only one, which is, you will see it right down the line, and that also is a PCB manufacturer rather than actually a EMS play. But the fact is that we are not too comfortable. I think the China 1+1 that we were always talking about, I think we missed that bus a long time ago. And why I'm saying that is because now the world is not shrinking at all. It's world wants the supplies to be near shore or onshore, and that also high tech supplies. The low tech they don't mind giving out for outsourcing, and you can see that, right? I mean, all the names that you took, you look at the margins of these companies, and you realize that this is not too exciting a business that is being done. It's mainly an assembly job which is being undertaken per se. So that's why we're not too comfortable with the other players, and that's why we're out. And anyway, the valuations, as you rightly put it, are very stretched for those kind of margin levels.
With that, Mr. Irani, time draws very near, and I don't know how the last 29 minutes lapsed so quickly. They were over in 29 seconds. As always, it's such a pleasure to listen to you, to defend your picks, and of course talk in such simple terms about how markets compound and how they make money. As always, it's been a pleasure, and here's wishing you all the best for the second half of 2025. May the portfolio blossom even more.
Thank you, Shailendra, and wish you all the best too. Thank you.
That, ladies and gentlemen, was Mr. Dinshaw Irani, the CEO of Helios Capital and man behind the success of Helios Flexi Cap Fund. He's extremely bullish on banks and NBFCs, many new entrants, and increase of positions in the overall AMC portfolio, and of course a pure absence of legacy tech players such as Infosys, TCS, HPCL, Tech Mahindra. Helios bets on new age internet companies like Policy Bazaar, Paytm, and the like, as also the fact that very few PSU stocks except for HPCL and State Bank of India in the top 20, and of course a deep absence of defense companies save for BEL and also the AMS space. I hope you enjoyed the conversation as much as I did. Wonderful having Mr. Irani over, and let's hope that the Flexi Cap scheme does wonders for unit holders of the fund. Thank you for watching.